Britain emerged from the Seven Years' War in 1763 as the dominant maritime and commercial power in the world, but it had paid for that war with enormous accumulated debt. Peace brought an explosion of commercial activity in the years that followed. New banks opened across Scotland and England. Merchants borrowed to finance trade. Speculators borrowed to finance speculation. The Bill of Exchange, a short-term promissory note that could be discounted by one bank and passed to another, became the connective tissue linking credit across London, Edinburgh, Glasgow, Amsterdam, and Hamburg. Each link in that network worked smoothly as long as confidence held. But each link was also a wire that could carry a shock at the speed of a courier. Scotland had developed a notably open banking system in the decades before 1772. Entry was relatively free, competition was vigorous, and Scottish banks issued paper notes backed by their own credit rather than coin alone. In November 1769, a group of Scottish landowners and merchants established Douglas, Heron and Company, based in Ayr, which became known simply as the Ayr Bank. Its explicit goal, as later historians of the episode have documented, was to fill what its founders saw as a shortage of credit in Scotland. It issued notes aggressively and extended loans that older Edinburgh banks had declined to make. At its peak, the Ayr Bank had issued a volume of paper that Adam Smith, writing nearby during the crisis, would later argue was more than the trade of the country could sustainably absorb. To fund its note issuance, the Ayr Bank relied heavily on London money markets. It drew bills of exchange on London correspondent banks and used the proceeds to extend credit in Scotland. When those bills came due, the Ayr Bank drew new bills to retire the old ones, a recycling process that contemporary observers sometimes called bill kiting. This chain of rolling short-term credit was not unique to the Ayr Bank. Many Scottish and provincial English banks operated the same way, but it created a structural vulnerability. If London credit tightened for any reason, the Ayr Bank and institutions like it would face an immediate funding gap they had no other way to fill. The question was not whether the chain would be tested. It was when. Alexander Fordyce was a partner in the London banking house of Neil, James, Fordyce, and Down. Contemporary accounts, as summarized by financial historians including Larry Neal, describe Fordyce as having taken large speculative positions in East India Company shares, with some accounts indicating he was betting on a fall in the price. The East India Company's financial condition was genuinely troubled in the early 1770s, making it a plausible target for such a trade. But the position moved against him. Facing calls he could not meet, Fordyce exhausted his firm's resources. The precise scale of his losses was disputed even at the time, and the exact direction of his wager is described somewhat differently in different contemporary accounts. What is not disputed is what he did next. On the night of June 9, 1772, Alexander Fordyce left London and crossed to France. He did not inform his partners. He left behind debts that his firm could not cover. When the market opened the following morning and his flight became known, creditors began demanding repayment from Neil, James, Fordyce, and Down. The firm could not pay. It failed on June 22, 1772. Word spread immediately through the tightly networked London private banking community. Within days, according to accounts from the period cited in subsequent historical scholarship, something close to 20 private banks had suspended payments. The mechanism was straightforward. Each bank knew that every other bank was exposed to the same bill of exchange chains, and no institution was willing to wait to discover how exposed its counterparties actually were. The cascade that followed was, in miniature, the same mechanism that would repeat in 1873, 1929, and 2008. London banks stopped discounting each other's bills. Merchants who depended on short-term credit to finance shipments suddenly had no credit available. The cost of funds for those who could still borrow rose sharply. The Bank of England, which at this point was a privately chartered institution rather than a public central bank in the modern sense, received appeals to expand its lending. It did extend some credit to ease the freeze, though scholars note that its response was relatively cautious by the standards of later interventions. What is clear is that the collapse of private interbank credit was real, rapid, and disorienting to everyone caught inside it. The shock traveled north almost immediately. The Ayr Bank, which had been rolling its London bills continuously, found that the London market had dried up. It could not place new bills. It could not retire the old ones. In late June 1772, the bank suspended payments and effectively ceased operation. It was wound up over the following years at great cost to its shareholders. Adam Smith, writing in Kirkcaldy while working on The Wealth of Nations, estimated in Book 2, Chapter 2 of that work that the shareholders of the Ayr Bank lost approximately £200,000, a substantial sum at the time. The shareholders were largely Scottish landowners and merchants who had invested in the bank expecting it to serve their region, and who instead faced calls on their stakes that left many of them in serious financial difficulty. Bills of exchange did not stop at the English Channel. Dutch merchant banks in Amsterdam had been active participants in the same credit networks, discounting British bills and extending credit to British merchants. When London froze, Amsterdam felt the effect within days. Several Dutch houses that had been heavily exposed to British bills came under severe pressure. Financial historians who have studied the episode, including Larry Neal in his research on 18th century money markets, have argued that the crisis of 1772 represents one of the earliest clearly documented instances of financial contagion crossing national borders through integrated short-term credit markets. That mechanism, a stress in one national money market transmitting almost instantly to every market connected to it through the same instruments, would become a defining feature of every major crisis thereafter. Adam Smith was in Kirkcaldy in 1772, working on the book he would publish 4 years later as an inquiry into the nature and causes of the wealth of nations. The Airbank disaster unfolded almost on his doorstep, and he devoted substantial analysis to it in Book II. His account, still regarded as one of the clearest early treatments of how aggressive bank credit expansion produces a boom and then a sudden contraction, identified the core flaw. The bank had issued more notes than the trade of the country could absorb, forcing it to continuously recycle bills in London to stay liquid. Smith argued that this kind of credit creation did not add real productive capacity, it merely pulled forward spending while accumulating fragility. His framing of that problem, drawn from a 1772 crisis, became a foundational reference in banking theory for subsequent generations. One of the underappreciated features of the 1772 crisis is how quickly it propagated. Fordyce crossed to France in the evening. By the following week, the London private banking market had effectively seized. Financial historians, including Charles Kindleberger in his widely cited work Manias, Panics, and Crashes, have observed that this speed is not incidental to how credit networks function but structural. When all participants in a credit network know that everyone else is exposed to the same counterparties, the rational response to any one failure is to stop extending credit to all counterparties immediately, before information about specific exposures can even be gathered. This logic, sometimes described as a wholesale bank run, is the same mechanism that froze interbank lending markets in September 2008, centuries after Fordyce sailed across the Channel. The formal legislative response to the 1772 crisis was limited. Parliament did not pass sweeping new bank regulation in the immediate aftermath. What changed more gradually was the intellectual framework for thinking about what a central bank should do in a panic. Walter Bagehot, writing in Lombard Street in 1873, drew on historical episodes including 1772 to argue that the Bank of England had a systemic responsibility it had not always clearly acknowledged. In a panic, the central bank must lend freely to solvent institutions against good collateral at a rate high enough to discourage casual borrowing but low enough to stop a self-fulfilling collapse. That doctrine, now called the Bagehot Principle and embedded in modern central banking practice, traces part of its intellectual lineage directly to the kind of sudden, network-wide credit freeze that 1772 so vividly illustrated. The mechanics of 1772 are not a museum exhibit. Every modern financial system still runs on networks of short-term credit where participants depend on counterparties they cannot fully examine. The bill of exchange has been replaced by repo agreements, commercial paper, and money market instruments, but the logic is identical. When confidence in one large participant breaks, lenders pull back from the entire network at once, rather than waiting to sort out who is actually sound. Understanding that structure helps explain why central banks act as lenders of last resort, why regulators require stress tests and liquidity buffers, and why financial crises so often feel sudden even when the underlying problems built over years. The plumbing runs the same way it did when Fordyce crossed the Channel in the dark in June 1772.